We're looking at what's ahead for markets as several key economic indicators come out this week. I'm Winnie O'Kelly reporting for Business Day Live. I'll be speaking to reporter Jessica Silver Greenberg. She's been covering the fallout from a security breach that has affected 1.5 million credit card holders. Brian Stelter from the media desk will also be joining me. He's here to talk about a booking battle between the major network morning shows. But first, I'm joined by Leo Grohowski. He's the Chief Investment Officer at BNY Mellon Wealth Management. Good morning, Leo.
Good morning, Winnie.
So we're coming off of a really great first quarter for the stock market after sort of, more difficult results last year. Everyone wonders, can this continue? What's your perspective?
I think it can continue, although probably not at the pace of the first quarter. The underlying fundamentals are still very supportive for the U.S. equity market. The economy's growing. Corporate earnings, we expect S&P earnings to be between $100 and $105 this year, which means a PE ratio of about 14 times. So the market is still pretty reasonably valued. Despite this run-up, it's been very well supported by earnings. Now, all that said, we're entering into a seasonally challenging period for the market. There's going to be more focus on the year-end elections and the massive fiscal cliff that our Fed chairman calls the expiration of tax cuts and austerity kicking in. So I think we might look back on this as the strongest quarter of the year, but we do think the market closes the year higher than where we're trading today.
That's a little different than how economists look at the year, because they've actually been expecting it to gain traction as we go forward. What do you expect, for example, short term when the jobs report comes out on Friday?
It's going to be a choppy week because it's unusual to have such an important report come out on a day when the equity market's closed and the bond market only has a half a day of trading. So I think this week is going to be a tough one to gauge the beginning of the second quarter. Now that said, I think the year when we tally it all up is probably one where GDP growth is 2 to 3% to answer your question, and again one that's supportive of higher corporate earnings, although not probably at the same rate of growth that we saw in 2011 versus 2010.
There's been a little bit of a debate about whether the jobs numbers have gotten ahead of GDP, if you will. Sort of, how strong is the underlying sentiment in the economy? What's your take on that?
Yeah, I've kind of run out of adjectives to describe the economy: muted, anemic, subpar. I think with all of the stimulus we've put behind our economy, 2 to 3% GDP growth is still not where we need to be. And I think encouraging news on the employment side, but as our Fed chairman said last Monday, right, it's still not normal, right? The folks who are out of work a lot longer. Hours worked are not where we want or need them to be. So I think we need to take, and also we have the broader civilian unemployment rate still hovering at around 15% when we take into account those folks who've given up looking for work or those who have taken on part-time jobs, although they'd like to work full-time. So I think we still have some wood to chop, but clearly an 8.3% unemployment rate, which is what we're still expecting to see on Friday, is better than a 10% unemployment rate.
And how that translates into the stock markets? Are there particular sectors we should be looking at?
Well, I think investors need to maintain what we call a barbell. I think, after a quarter like this, you don't want to give up on all of your defensive stocks, but you want to be positioned for ongoing growth in terms of some of the cyclical sectors. So in that vein, we like energy and technology. I think energy underperformed in the first quarter of the year, but we like the energy sector, especially thematically. If investors are willing to look beyond the next quarter or two, I think energy is a theme that's going to be with us for some years to come.
But you can't say technology underperformed in the first quarter. It's been carrying us.
Tech did extremely well, but cash on the balance sheet is a huge theme. I think it's why we're going to see a nice future for dividends, and tech is really leading the charge there. So some great cash flow numbers. I think we're going to see more merger and acquisition activity, share buybacks, and obviously, as companies are still cautious about hiring people, they aren't as cautious about hiring or investing in capital equipment and software to continue efficiency and productivity gains. So I do think the capital spending cycle continues to work in technology's favor.
The fund flows, if I recall them correctly, show that individual investors have been a little bit on the sidelines. It's been the institutions that have been plowing ahead. What will it take to get individuals to commit again?
Oh, it's a great question, and you're so right. There's still $2.6 trillion sitting in money market funds, earning effectively zero. In the first quarter, we saw net withdrawals from equity funds in addition into bond funds. Makes us very nervous. I think many investors may be overstaying their welcome in things like intermediate term government bond funds, which feel well, but My hope is that when investors look at their statements this quarter and they see that many bond funds produced somewhere around zero, give or take, return, I think that's a little bit of a wake-up call to at least consider rebalancing portfolios back towards a more normal equity target. So I think it's a process. I've said, cynicism, skepticism is still really high, and that's not going to unwind itself over the next couple of months or even quarters. So I think that's an ongoing process.
That's so interesting. Thank you very much for joining us today, Leo.
Thank you for having me.
Last night, Visa and MasterCard described a security breach at a company called Global Payments. That company is responsible for handling online transactions. I'm joined from our newsroom by Jessica Silver Greenberg, who's been following the story. Hello, Jessica.
Hi, Winnie.
So this is a really opaque business. Consumers have a very hard time understanding it. They have a MasterCard or a Visa brand on their card. There are banks that issue their cards, and yet there are these other companies that are handling their transactions. Can you explain this to us?
That's right. Consumers don't really, I'm not sure they realize that there's this third party that is responsible really from the time that they swipe their card at a store to the time that that payment gets sent to the bank. These companies, Global Payments is one of them, they process millions of transactions a day on behalf of Visa and MasterCard, and they are largely in the shadows.
So when you pay at your taxi, even in New York, where you swipe your card, it's not your bank, it's not Visa, it's one of these companies that's handling it. And now we've seen this big breach, right? 1.5 million cardholders have had their information. How does this compare to other breaches in the past?
Well, it's small relative to other breaches which have been much larger. A breach at another major payment processor called Heartland Payment Systems. In that breach, which was reported in 2009, roughly 130 million credit card accounts were compromised. So this, compared to that, is relatively small. But again, we are talking about 1.5 million credit card accounts that may have been compromised.
So Visa said it's not going to use Global Payment anymore. Does that really have any effect?
No. What we're hearing from both Global Payments and industry consultants is that it has virtually no effect on Global Payments' ability to process transactions for Visa cardholders, and to actually, the company is allowed to sign up new merchants to also process Visa transactions. So a lot of the hoopla and attention that's come from Visa's latest move to disqualify Global Payments or to remove them from their list of approved third-party processors, a lot of that is, it's a lot of noise, but it doesn't have real implications on the day-to-day business.
So help me understand, Congress looked at this a few years ago and talked to the industry. Who's really regulating what happens here with these companies?
Well, and that's an interesting question, because that's what this breach has really highlighted, I think, is the gap in regulation of third-party processing. Any oversight of the processors falls largely to the states at the moment, but those laws really govern what happens after a breach, not the security that has to go into place before a breach occurs or to prevent a breach. So the laws govern things like when you have to contact consumers if their information has been compromised. So this is a regulatory gray area. In fact, there's really no federal oversight of this at the moment.
So we'll be looking to see what happens there. Thank you so much, Jessica.
Thank you.
And finally, a battle is brewing between the morning television shows this week. These shows are sources of ad revenue for the television networks that's significant. Brian Stelter joins us from our media desk to talk about why the competition is increasing among the shows. Thanks for joining me, Brian.
Thanks.
So we're seeing these incredible headlines. Katie Couric's coming back. Oprah's going to be on. What's going on here?
For 16 years, the Today Show on NBC has been the #1 morning show. No one else has gotten that close. There's no other streak like that in television. No other show, no other time of day can claim to be #1 like that for so long. But ABC and Good Morning America is right on its tail, the closest it's been in years. They're basically right now, they're one suburb away from being the Today Show. And so that's why this week they brought on Katie Couric all week, the former Today Show anchor, to try to beat Today.
And so there's some irony in that, right? She's here at a totally different spot.
Right.
Now, what are the other competitors going to do, right?
Well, basically it's a full week of this. So Katie Couric's on for a full week. That means that ABC has 5 days to get NBC viewers to just come over once and try it. that's the genius, perhaps, of what ABC is doing. Is they're not just doing a one-day stunt. They're bringing on Katie Couric 5 days in a row to get you to try to change the channel and try their show. In fact, headline on the Daily News this morning was this: Katie Couric, Sarah Palin, kind of an arguably sexist cover, but it shows them punching because tomorrow morning Sarah Palin's going to be a co-host on Today's Show. Now, of course, 4 years ago, Katie Couric had that famous interview with Sarah Palin that some people say really damaged Sarah Palin's brand. So it's really a rematch. That's how it's being portrayed.
So help me understand what's at stake. How much money is really involved in these morning
There's
shows?
really a premium associated with being number one. There's a psychological benefit of being on top, but there's also a financial premium you get in terms of your ad revenue. And these morning shows really bolster the whole news divisions for NBC, ABC, and CBS. They help pay the bills, keep the lights on for all the other news shows. Because after all, they're on for 2, 3, sometimes 4 hours a day. So they've got a lot of ad time, a lot of air time to fill. That's why they're so pivotal.
It's going to be interesting to watch this week. Stay tuned, right?
Yes, exactly.
That's all for today. Please stay with us online at nytimes.com for our continuing coverage of this and other stories. I'm Winnie O'Kelly, reporting for Business Day Live. Thanks for watching.